Welcome back to Market on Close. I'm Caroline Woods. Just a few minutes left in the trading day. We have about 9 to be exact. It's time for the big picture. Let's welcome in Collin Martin, Director, Fixed Income Strategist, Schwab Center for Financial Research. Collin, thanks so much for joining us.
Hi, Caroline. Thanks for having me.
So we've talked a lot about the equity market so far on this show, Collin. So bring us up to speed on what we're seeing in the bond market, because stock's selling off, but doesn't seem like that money's going into bonds.
No, it doesn't look like it. It's been a weird couple of days when you look at the action with the stock markets versus the action with the bond markets. When you see this sort of stock market volatility, especially this late day, price decline with stocks, usually you see that flowing into safe havens like U.S. Treasuries. But we're seeing U.S. Treasury yields pretty much, holding steady for most of the day. And I think it's really interesting, the dichotomy we're seeing with the S&P 500 down, 10% or more since when the tariffs were announced. But intermediate and long-term Treasury yields are at or higher than the levels they were back in the middle of last week. So I think that's really interesting there. I think there's a few ways we could be looking at the stock market. Clearly is pricing based off of the concerns that we're seeing due to tariffs. If the tariffs, as scheduled, remain in place for a while, that's a bad thing for the economy. It should slow growth. It could boost inflation. That's not a combination we're looking to see. But we've gotten some concerns or some comments from Fed officials that they're not as aggressive as the markets are in terms of expectations for what the Fed may or may not do over the next few months. And Fed officials today, again, we got San Francisco Fed President Mary Daly talking about the Fed funds rate being in a good place right now. Last week, despite the market turmoil, Fed Chair Powell said that the Fed is not in a hurry to cut rates. So I think it could be reflecting that a little bit, that yes, there's a very uncertain economic outlook right now, but the Fed might not necessarily cut rates given the uncertainty and given how inflation's still relatively high.
How disappointing could that be for this market, seeing as it's pricing in 5 rate cuts this year?
I'd say that is pretty disappointing, or would be pretty disappointing, Caroline. I'll hedge that by saying I'm not a stock strategist or analyst, but the idea that there would be no Fed put, I think, would be concerning for stock investors. So that could be an issue as well, because again, we're getting these comments that the Fed is making it pretty clear that they are in no rush to cut rates. I think that can change, though. I mean, right now, as it stands here in early April, the economy, from the data we've seen, continues to do okay. The labor market was relatively strong based on the results we got last week with the non-farm payrolls report. Yes, we saw the unemployment rate tick up a little bit, but not at levels that are too concerning. If that were to change fast, if we were to see the unemployment rate start ticking higher, maybe get to 5%, which would be admittedly a very big jump from where we are right now. But if we were to see that over the next few months, that would be concerning for the Fed. And then that's probably what would result in them cutting rates as aggressively as the markets are expecting. But they really need to see that in the data before they start cutting like the Fed funds futures are implying right now.
Okay, so there's the dual mandate. You talked about the jobs side of things, but then there's the inflation side of things. We do have CPI and PPI out later this week. But similar to the jobs data, which was backward looking and didn't necessarily include the DOGE cuts, do you think that the market could potentially shrug off those 2 reports because it wouldn't include the impact from the tariffs?
Yeah, I think so. I mean, right now we're in this kind of weird economic environment where the data we're getting doesn't really matter that much. So yes, so when we get the CPI report, it's going to be very backward looking. It's likely to show that inflation remains sticky. But as I mentioned before, if these tariffs remain in place as scheduled, then that can keep inflation sticky or can risk reaccelerating. So I don't think the markets are really going to move too much based on the economic data in the near term. It's really going to be comments from Trump and the White House and various officials about what the plans are, if any deals are being cut. And until we get more clarity there, the economic releases will probably take a back seat.
Yeah, and there's no shortage of headlines coming from the White House to keep us busy, that's for sure. I think, though, you talk about kind of what the stock market is reflecting. What does a 10-year yield at 4.26% say to you?
No, that suggests that the Fed is not going to cut rates as much as the markets are currently pricing in right now. It also could be pricing in the idea that this is just a negotiating tactic and some of these tariffs get rolled back. I think that's the big question right now. Because again, we are seeing these very different movements with stocks and bonds right now. And it's an unanswered question of who's right and who's wrong. Because if we look at what's happened over the past week, if in a few days or a week or 2 weeks time the tariffs are rolled back or reduced significantly, a lot of what we've seen would likely be reversed. We'd probably see treasury yields move a decent amount higher. Given that we're back at around 4.25% on the 10-year, I don't think it would move significantly higher, maybe the 4.5% area. But it could be, pricing in the idea that maybe it's not as bad as expecting. So there's a lot going on right now. I think it reflects just all the uncertainty we're seeing out in the markets.
So Collin, just finally, what's your advice then to bond investors right now?
Yeah, our advice is to not do anything too crazy. We still suggest our up in quality bias, and from a maturity or duration standpoint, we're suggesting just an at benchmark maturity or duration. That's average maturity is around the 6 or 7 range, in line with the U.S. aggregate index. We're not suggesting investors go too short, meaning all in cash. We're not suggesting they move to long-term bonds because there is a lot of risk to both sides in terms of yields rising in case these tariffs get rolled back, or yields falling in case they stay in place and we see a recession sometime soon. We're also, still pretty cautious on credit right now, because when you think about high yield bonds, bank loans, they tend to be highly correlated to the stock market. So if we get this stock market volatility, we could see some more weakness there. But if this continues, it could present opportunities down the road. So we're paying attention to high yield bonds right now. If we see spreads rise another 50, 100 basis points or so, we think it could present a more attractive entry point.
Okay, we'll leave it there. Collin Martin, Director of Fixed Income Strategist at Schwab Center for Financial Research. Thank you so much.